The stock market can feel totally chaotic, right? Just this unpredictable beast. We're always told it's all about earnings reports and economic data. But what if one of the biggest drivers isn't in a spreadsheet at all, but inside our own heads? So today, we're going to dig into the hidden and hugely important role of fear in finance.
Look, this is not a new debate, not by a long shot. Way back in 1936, the famous economist John Maynard Keynes was already talking about animal spirits, those emotional gut feelings that drive what people do, especially with money. He was basically saying that even when we think we're being perfectly rational, a lot of the time we're just going with a whim or a feeling.
And that really sets up this central mystery for us today. We're diving into a fascinating paper from researcher L.A. Smales to try and figure out what's really pulling the strings in the market. Is it cold, hard logic, or is it raw human emotion? All right, so let's get into it by breaking down the two big forces at play here. Just picture them as two sides in a constant tug of war, both trying to control a stock's price. So on one side, you've got fundamental value. This is the by-the-book price, right? It's calculated using hard data, profits, cash flow, all that good stuff. It's what a stock should be worth. But then on the other side, you have investor sentiment. And this is all about feelings, the collective fear, the greed, the hype that's just swirling around the market at any given moment. It's when investors feel a stock is worth. And the clash between those two, well, that's where things get really, really interesting. But how do you measure a mood? I mean, seriously, investor sentiment is totally invisible. It's not like you can find fear on a balance sheet. So to track it, researchers have to kind of play detective, looking for clues, or what they call proxies, that this hidden force leaves behind. And that's the big challenge, isn't it? If you want to prove that emotion is what's driving the market, you first need a solid way to put a number on that emotion. So where did the researchers even begin? Well, they assembled a lineup of the usual suspects. They looked at direct stuff like surveys that literally ask investors, hey, are you feeling bullish or bearish right now? And then they looked at more indirect clues like overall consumer confidence, the buzz around new IPOs, and of course, the CBOE's volatility index, better known as the VIX. The question was, which of these clues, if any, could actually predict where the market was headed next? After running all the tests and crunching 25 years of data, the investigation started to zero in on one particular measure. It stood head and shoulders above all the rest. They had found their smoking gun. And it turned out one of these clues wasn't just tagging along for the ride. It was actually in the driver's seat, seemingly causing the market to move. Meet the VIX. You've probably heard it called the investor fear gauge. Basically, it uses options prices to measure how much turbulence the market is expecting over the next month. All you really need to know is this. When the VIX is high, fear in the market is high. Simple as that. Okay, and this is the absolute kicker from the paper. Using some pretty sophisticated tests, the research showed that this is a one-way street. Changes in the VIX consistently happened before changes in stock returns. So fear wasn't just a reaction to a falling market, it was actually a cause of future market moves. Now, this is where the story takes a really fascinating and honestly kind of counterintuitive twist. We've established that fear is a powerful force, but what does that actually mean for your money? I mean, your gut instinct is probably telling you this. If everyone is scared, that has to be a terrible sign for the stock market's future, right? It just makes sense. Well, the data says something completely different. The paper discovered what's called a contrarian relationship. Here's how it works. First, investor fear spikes. The VIX goes way up. Then, all those panicked investors start selling everything, which pushes stock prices way, way down, often way below what they're actually worth on paper. This basically creates a market-wide bargain sale. And then, once that peak fear finally passes and things calm down, prices don't just recover, they tend to snap back up with a vengeance, leading to higher than average returns in the months that follow. Okay, so this isn't just some abstract theory. It has real-world implications. The research gives us a pretty clear map of who gets hit the hardest by these waves of fear, and also when they hit the hardest. It turns out, fear doesn't treat all stocks equally. The effect is way bigger in sectors like tech and telecoms. The ones where valuations are more of a story about the future and kind of subjective. It's also really strong in small-cap stocks that are prone to speculation. But for the boring, stable, easy-to-value sectors like utilities, investor mood just doesn't have nearly as much of an impact. The economic backdrop also matters a lot. The paper found that the predictive power of a sudden spike in fear is nearly 3 times stronger during a recession. So think about it. When the economy is already on shaky ground, that same jolt of panic hits the market way, way harder. So, what does this all boil down to? Well, the study's conclusion is direct and it's powerful. While hope and hype can definitely create bubbles, it's fear that acts as the more potent and frankly more predictive force in the markets. The prospect of losing money is just a much stronger motivator than the prospect of making it.
And that leaves us with a final big question to chew on. The next time you see the headlines screaming about a market panic and that fear gauge is spiking through the roof, what are you going to see? Will you see a sign of danger, a reason to run for the hills, or will you maybe see the faint outline of a future opportunity? Thanks for tuning in.